Conversations That Matter is a partner program for the Centre for Dialogue at Simon Fraser University. The production of this program is made possible thanks to the support of the following and viewers like you.
Murray Leith, welcome. It's good to have you back.
Great to be back.
You know, about 18 months ago, you were here at a time in August of 2015 when we had seen about a 1,000-point drop in the Dow, and everybody went, oh my gosh, what's happening? Is the world coming to an end? China's slowing down. And you said, relax. You know, markets go up, markets go down. But right now, I read the headlines this morning, markets around the world are up more than 10% over the last 2 months. What's going on? Is this a Trump bump?
You know, everybody's calling it the Trump rally.
Yeah.
But I actually would argue that there's, fundamental economic reasons for the strong performance in the stock market. You know, when we met 18 months ago or even a year ago, there was a slow patch in the global economy.
Right.
Stocks were down, commodity prices were down. People thought that was foretelling of a coming economic recession, but it wasn't. Really, ever since the financial crisis, the ebb and flow in the economy has been driven by changes in interest rates and commodity prices. And when they go up, 6 to 12 months later, the economy tends to slow down. And when they go down, the economy tends to pick up. With a similar lag. And so, what was happening a year ago is that we'd been through a period of higher interest rates and commodity prices, and lo and behold, a few months later, the economy slowed down. But by the time, a year ago, oil had fallen in half, interest rates had dropped a ton, and with that stimulus in the pipeline, we had some confidence that the economy was going to pick up again. And that, if you look at the Citigroup Economic Surprise Index, it was going down at the beginning of the year last year, and then it just progressively got stronger heading into the election and year end. Mm-hmm. And, that coincided with the rise in Trump's popularity, the surprise winning of the election. So people point to Trump as the reason for the stock market performance, but really, there's some pretty solid fundamental reasons. U.S. GDP growth was, I think, 0.8% in the first quarter, 1.5% in the second quarter, more than 3% in the third quarter.
3%, that's significant. That's like China being at 6 and 7%, isn't it?
That's been pretty good, certainly for the post-crisis recovery. 3 is about as good as we've done on a quarterly basis.
So when we looked at that slowdown back 18 months ago, China was a big part of that because we were seeing it slow down. But it seems to have stabilized. And how important has that been in the overall mix of what's going on in global markets?
Well, China did indeed slow down, and then the authorities there, stimulated the economy by doing things like lowering some of the taxes on housing or relaxing some of the restrictions on housing and taxation on autos. They ramped up government spending. They're unwinding some of those things now. So China's been stronger, and that's helped the global economy. But there's actually reasons to believe that it could slow down again in the future.
Mm-hmm. But the United States seems to be the real driver right at the moment. What happened there in the last 12 months since we've seen this rise? Because I know that when I talked to you before we had this conversation, said, is Trump the reason why? And you went, no. It's a coincidence, but it's not a cause. So what are the fundamentals that are at work there? And then how does that look going forward over the next 6 to 10 months?
The reality is that we are living in a slower growth world. And the principal reasons for that slower growth are too much debt and demographics. Much like an individual that's run up the credit card, once you've maxed it out, you have to live within your means. And that means less spending or, less economic growth. There'll be growth, but it's slower. And demographically, we know the world's population is aging. Mm-hmm. There's fewer workers entering the workforce every year, and that's not just true in the developed world. It's true in emerging markets. So population growth is a lot slower than it used to be, and we know that it's going to continue to be slow for at least the next 2 decades because we know how many babies and elementary school and high school kids are out there that are going to be entering the workforce. So between debt and demographics, there are some solid fundamental reasons why growth will be slower. And Trump or any administration is not going to be able to change that fundamental fact. So growth this cycle has been slower than what we've experienced in past cycles for that reason. And the economy ebbs and flows because of things like changes in interest rates and commodity prices. But 2% growth in North America is probably what we should expect. We're not going back to the 3 or 4% growth days.
And yet we're seeing quite a significant bump up in stock market values. The Dow cleared 19,000 when Trump got elected, and it's like staying up there. It's not like it hasn't dropped back. So
yeah, but the market hadn't had a strong year. Like it had been holding back, and it was tentative. It wasn't rising a whole bunch throughout the year, despite the improvement in the economy. So it made up for that after the election. But on the whole, I think the market was up about 10% for the year.
Yeah.
That's not exactly a barn burner euphoric year for a stock market.
But it's still pretty good, especially once you start getting up.
It's pretty good, and it's consistent with an economy that improved.
Right.
But, I think there's this feeling that, because the market didn't do a whole bunch until after the election, that, it's all about Trump and that maybe it's investors are too euphoric. But really, a 10% return in a year when the economy went from bad to quite a bit better, that's pretty reasonable.
Are we seeing an influx of cash into markets and maybe out of bonds? Is this playing into what's happening as far as markets are concerned?
A little bit, but I don't think a ton. Your average investor is still, fairly tentative, maybe cautiously optimistic would be the best way to describe it. But, you get worried when there's euphoria out there, when everybody's in with everything they have.
It's almost a sure sign that it's going to go down.
Valuations don't make any sense. You're scratching your head. We're not anywhere near that, I would say.
Huh. Okay. So when we see a rise like this, a number of people say, I better get in. Is that dangerous thinking?
It's human nature to get excited and buy more when things go up and panic
it's human
and
nature
sell
to panic and get out
and sell and it really, we're always saying it's those that accept volatility and stick to a long-term plan invariably do a lot better than those that try to anticipate.
That's exactly what you were saying 18 months ago. So it hasn't changed.
It doesn't change. So being a long-term investor, owning businesses where we have confidence and conviction that they're going to be bigger and better and more valuable 3, 5, 10 years down the road, that's what you want to focus on. In this day and age, with the internet and the 24/7 news cycle, it's so easy to be distracted and thrown off your game.
So every year you go out and you do your annual talk to the people who are clients of Odlum Brown. What are you telling them this year?
Well, the top of mind question that we get asked daily is, how does Trump change the portfolio or your portfolio strategy? And the quick answer is, he doesn't. There's been political upheaval, and Trump was elected because voters are upset with the pace of growth in the world. But the slow growth reality was around long before Trump even decided to campaign for the presidency. And we, in fact, repositioned our portfolios for a slower growth world more than a decade ago. And the repositioning involved moving out of cyclical Canadian resource companies into blue chip, higher quality U.S. companies. And that's a posture we've maintained for more than a decade. And the reasoning is that you want to own better, higher quality businesses that generate above average profits in a sluggish economic environment, because for two reasons. Those are the businesses that have the means to get ahead in a sluggish environment. And they're also the businesses that you can be confident that are going to be the last ones standing in the event of a storm.
So as a Canadian, I'm always disappointed when you say, we're looking at staying out of those cyclical Canadian markets, because I keep thinking, well, I want it to be good for Canada. But as an investor, you're saying we're better off looking south of the border.
Yeah, you know, we're not. We own some cyclical, you know, energy stocks and you know, other commodity businesses, but we're nowhere near weighted to the extent that they are in the benchmark Canadian index. But when you're trying to find, you know, great companies with sustainable competitive advantages, above average profitability, great managers, you know, and a long runway to grow that business over time, when you're looking at a much bigger universe south of the border, it's easy to pick out those winners.
So what sectors in particular are you looking at then that make up part of, like, I guess the majority of your portfolio?
We like things in all sectors. At our annual address this year, the team's talking about 5 companies in particular. The first one is, you know, we're talking about a company with great growth, but it's in a dull and boring forest products industry. It's Stella Jones. They Stella Jones. Yeah, no, it's not a beer company or a cosmetics company. It's actually a forest products company, and it was spun out of Domtar in the early '90s, and because it was too small. And today it's bigger than Domtar. And they've taken a sort of mundane, dull and boring business and growing it intelligently through internal initiatives and acquisitions. But they manufacture railway ties and utility poles. And
2 things that are not going to go out of use.
No, and they have to be replaced year in and year out, and they've consolidated a fragmented market on both of those businesses, more so on the railway ties. There's a lot more future opportunity on the utility pole business, but it's actually been the best performing stock on the TSX over the last 15 years. So that's a company, and it's
Is that
Canadian.
a Canadian
That's a
company?
Canadian company.
Okay, so that goes against what you were saying.
You know, another Canadian company that we're going to be talking about is Peyto Exploration, and we like it because the management team there has a counter-cyclical investment approach. You know, most people, most management teams in the oil patch invest more when commodity prices are high, but that normally sets the stage for the cycle to turn down when there's overinvestment at the top of the cycle. They do the opposite. They step up their capital spending when it's cheaper to buy properties and invest in natural gas wells at the bottom of the cycle. And because of that, they've grown much faster than their peers over the years.
Last year you talked about Canadian Railways, in particular CP. Is that sector still strong because of our ability to deliver goods from the West Coast into central United States? And if the U.S. economy is up and they're bringing in more goods, is transportation a good sector to be in?
The railways is a good business. It's highly concentrated. They have the ability to raise prices year in and year out. You know, the business shorter term will ebb and flow with the economy, but as long as the economy's doing okay, then it's a business that's going to do well.
But is it in the sectors that you're promoting this year at the annual address?
You know, we have things that we like in all sectors. We're broadly diversified in our model portfolio.
And that's the key, isn't it?
Well, generally that's been the key. And you know, the Canadian market is not well diversified. It's highly concentrated in, you know, energy, materials, and financials. You know, that accounts for about 70% of the market. You know, most money managers tailor their portfolios to mimic that benchmark pretty closely. We don't think that. We think it makes sense to have more diversification. And the Canadian market, you know, is there's been so many takeovers and consolidations over the years, and that it just doesn't provide the diversity that it did 10, 15 years ago, which is one of the reasons why we tend to look a bit more outside the country for those diversification opportunities.
So what are some of the other companies that you're focusing on in your annual address?
Amazon is a company that we're talking about this year, and you know, online retail sales just keep growing year in and year out. I don't know if you shop on Amazon, but I
Doesn't everybody?
started buying books, and you know, it just the list of things that I purchase online.
Well, they
and
made
mostly,
shopping easy.
Well, they did, and I always go to Amazon first because I'm a Prime member, and I know that the package is going to arrive, you know, in a day or two.
Yeah.
Which is just truly amazing. So, you know, the thing that is going to drive Amazon's business and why it's not hard to believe that this is going to be a bigger, better, stronger, more valuable company down the road is that, you know, online sales, our penetration, are going to continue to take over from brick and mortar retail sales, and Amazon's a leader there, so they'll grow on that front. But other retailers are also using Amazon to fulfill orders and deliver them because they do it better, faster, and a lot cheaper than they can do it themselves. So these businesses can't afford not to use Amazon. But what a lot of people probably don't realize is that Amazon's also in the cloud business.
Yes.
They were actually the first and the market leader, and they have about 35% of that market, and it's growing very fast. So that's another big growth driver for the company.
So that's 3 of the 5. What are
Three of the 5.
What are the other 2?
Coty is a cosmetics company that's been around for a long time. It's the principal investors in the business are JAB, that are some individuals that have had a lot of success with other investments, and they've grown Coty. They manufacture a lot of fragrances and makeup lines that we've all heard of.
Oh, okay. So not under their own name.
No, they're like the
They're
the
a white label.
Gucci's and the CoverGirls, and you know they manufacture them for other people, just like every designer brand that you buy out there. They're not manufactured by the companies that own the brand. And
the final one?
Element Fleet, and they manage fleets like Chevron's trucking fleet or Johnson & Johnson's trucking fleet and vehicle fleets. And they provide the leasing, but people people sort of think of that as maybe being a risky business, but it really isn't. Their credit losses on the leasing business are a fraction of a percentage point. The big banks typically have loan losses that are about 10 times what these guys experience on their leasing business. So that's not really a worry for the business. But what's more interesting is all the other services around these fleets that the company manages for the Chevrons of the world. They look after insurance, they look after maintenance, they look after fuel, and you know the list of things that they do and do better than companies can do internally is very long, and that creates a retention rate with these customers that's like 98%. So it's a recurring business that they do very well. There's a lot of opportunity to get more customers that are today managing fleets in-house. There's an opportunity to do acquisitions, and there's other drivers of growth here.
So the common denominator in all of these companies that you're focusing on this year is that they're smart businesses. Like they're not going for flash, but they're finding opportunities.
Well, they're great businesses. They have, you know, sustainable competitive advantages that lead to above average profitability. And then they have great management teams that know what to do with the profits from, you know, those great businesses. And they have the opportunity to reinvest in the business. But one of the things that we've learned over time is that, you know, an investment plan is only as good as the clients can execute it. And when you're buying companies with warts, it's hard to hold them through a storm. It's much easier to have the confidence and conviction to hold a great business over the long term. And in this day and age, in an over-levered world where growth is slower, it also makes more sense to own those great businesses. So you want sustainable competitive advantages, you want great management so they're doing the right thing with the profitability of the business, and you want the growth runway.
But you also touched on the fact that it's important to hold on to those over the long term.
Yeah.
Why is it important to stay with those picks that you've gotten behind and own a piece of that business? Rather than jumping around and trading as things are moving in the market?
Well, it's much more tax efficient because every time you trade and crystallize the capital gain, you're starting with less capital. It's much more tax efficient and profitable over the long term to let the business do the work for you and grow internally.
But people get emotional about stocks and they go, but there's an opportunity there that I'm missing. Or, oh my gosh, I got to bail out because it's cascading downwards. Because they think that by doing so, they're protecting themselves. What I'm hearing you say is you can't think that way. You have to have a long-term strategy.
Well, that's human nature.
Yeah.
And that is why most people do poorly. You know, so you have to fight human nature. We all feel it. I feel it, you know, like I get excited when the things I own go up and, you know, but I think about it and I'm not going to buy more when it goes up. I'll wait until the company stumbles and everybody hates it and is focused on the short term and missing the long-term picture. You know, like a company that I follow, it's a phenomenal company, is CarMax. They're the biggest retailer of used cars in the United States. It was a spin out from Circuit City 23 years ago. And they've taken a long time to perfect the business model. Customers love it. Employees love working there. They've grown from 1 store to 170. They've got a business model that they can expand for many years to come. And it's not hard to imagine this company being 2 or 3 times bigger, you know, 5 to 10 years down the road. The point is that if you're trying to anticipate how the market's going to react to these short-term, quarter-to-quarter things, running to the sidelines, you're going to miss out on that opportunity to own a business that's going to be 2 to 3 times bigger down the road. So we just accept that, you know what, these businesses are going to go up and down with the stock market or based on little things that happen quarter to quarter, but we want to own the ones where it's not hard to imagine them being bigger, better, stronger, more valuable.
And that fits into having a long-term strategy. The investment isn't about making a quick gain. It's about a long-term strategy that's going to help provide for you in the future.
You know, I've learned over the years that, you know, we have a great team of analysts and we do add value with the suggestions that we make to move in and out of stocks from time to time. We don't trade nearly as much as we did in my earlier years at the firm. But what really generates the wealth is just buying good stocks and holding them. It's like going around the monopoly board, collecting properties, putting houses and hotels on them. That's what wins the game.
It's great advice. Thank you very much for coming in and doing this.
Thanks, Stu.
Yeah.